thank you very much for joining us in our In the Room webinar on this fine Friday morning. Very much the World Cup fever is hit South Africa, and today I'm joined by Charlie Dutton in London. Hello, Charlie. How are you doing?
Dave, good to see you.
Yeah, good. So today we're chatting about the theme is global recessionary fears prevail. Which companies will win and which will lose? Almost sounds a bit World Cupish, actually, rugby-ish. And as I said, I'm joined by Charlie. Charlie's part of the 91 quality team based in London. So we're really getting a nice kind of global view from Charlie, and that's actually why we are not in the room, as I think a lot of you guys, the audience who join these webinars know, I like to go to the asset manager's office and sit with them and get a sense and a feel of the business. I try to get some budget to fly out to London for this one, but unfortunately, the finance guys said no. You can do it via Zoom instead. So just a couple of house rules before we get going. My name is Steve Backhouse. I often forget to introduce myself. I'm the host of the In the Room webinar series. So as I said, welcome. Thank you for joining. Really do appreciate your time. So what we're going to do here is Charlie and I are going to chat for about 20-25 minutes. Very much about kind of try and get into Charlie's kind of mind, how he thinks about kind of the world that he looks after. Then we'll ask questions you can ask questions to the audience via the Q&A tab. So please pose your questions. My colleague Arifa does moderate the questions and then puts them on the screen for me to ask. And at about 10 o'clock or so, we'll get to some of those questions, and I'll pose them to Charlie. And we'll ask those. We'll go through those for kind of however long we need to get back to the topic at hand, and then we'll close at 10:30 sharp. So we'll take an hour of your time. Importantly, the CPD points. So I think you should get one CPD point for today's webinar. Please stay on for the whole hour to get that CPD point. If you have to drop off, then you will need to do a short assessment to get your CPD point. And I think that's it from my kind of house rules. I do have to check my notes. Yeah, that's good. Cool. Okay, Charlie, we can get straight into it. First off, we were chatting earlier, and I always like a little kind of icebreaker. You were chatting earlier about your first day of work, which was in Hong Kong, and it was quite an interesting first day of work. Maybe you can tell the audience that story.
Sure. I mean, first of all, I'm a bit disappointed that they only get one CPD point for this. I mean, surely it's going to be more valuable than that. But anyway, so I started my career. I actually did this is in 1997, and I'd fresh out of university. I got a job with HSBC. Did the graduate course in London. Got on a flight. Moved my worldly possessions. So I had one suitcase with me, and arrived in Hong Kong on January the 2nd, 1998, and turned up to the office to find that the people who'd hired me and half the office had been fired the day before, New Year's Day firing, which is always nice. And I sat down, and they were like, my new boss, who I'd never met, just went, "Well, I wouldn't get too settled. You're going to be kicked out within the next couple of weeks because we're all going to lose our jobs." I thought this was some sort of first day broker joke. What do you mean? Of course not. He said, "No, I'm deadly serious." Anyway, over the next 2-3 weeks, I made more copies and printed more stuff out of the printer, and was more helpful than you can possibly imagine in the place. And meanwhile, people were disappearing around me left, right, and center as they got fired. And the end of my kind of 3-week period there, they just they sat me down. I was like, well, this is it. I'm about to get done. The Asian financial crisis has hit. It's all over. My career's finished in the first few weeks. And they said, we've worked out that actually you are cheaper than our annual stationery budget, so we decided to keep you. And that was my first introduction to the world of finance, and didn't look back since. So then had the next decade in Hong Kong, doing various different research roles there. But it was quite an introduction, and it really, I mean, when we had the GFC, I have to say the GFC was a walk in the park compared to the Asian financial crisis for the individual countries involved, because places like Indonesia, Malaysia, Thailand, which these were the tiger economies, just got set back to zero because they just had no financing left. So it was a fascinating period.
Yeah. So a couple of things actually stand out for me in that story. One is, and I've got a younger brother who's 10 years younger than me. And I've always said to him, just make yourself valuable. Whatever you do in your career, make yourself valuable. And that's exactly what you did, as you said, not necessarily in your actual role, but to the people around you. And that, I think even that is just proves that lesson. And the second thing that stands out is that, I mean, that experience of starting in a financial crisis is quite something.
Yes.
And I think a lot of, we attended an investment summit early in the week, and one of the things that came out of that conversation was that there are a number of kind of individuals in our industry who've only lived through certain types of economies, the US printing money, kind of low inflation, low interest rates, and actually these crises and different scenarios are so important in terms of understanding your investment kind of universe.
Yeah, no, completely. And I remember the time there where there was a situation going on in Hong Kong at that time where the large global hedge funds were shorting the dollar because the dollar was pegged. And basically, the way they were shorting the dollar in effect was by shorting individual stocks, which caused the peg to come under pressure. And it was the first time I saw this happen. And obviously, we then saw it happen in a different scale with the global financial crisis. But the Hong Kong Monetary Authority came in one day, and we were at HSBC. And they came in, and we suddenly received this order to buy tens of billions of dollars of stock. Like, it was extraordinary. Like, at the time, Hong Kong traded maybe $1 billion a day. And they just came in and they just swept the whole equity market up. They squeezed the shorts out. And it was my first experience really of what central authority capital can do on scale, which obviously we've now seen replicated in a different way. But at the time, it was a real shock to the market.
Yeah, that's fascinating. Yeah. So to get into the conversation as well, I mean, so you are an Asian equity specialist, part of the quality team, but your focus is very much on Asia. I think your experience that you spoke about now kind of highlights that. So, I mean, what are the big couple of themes that are coming out of Asia at the moment that would be interesting to our audience?
Yeah, I mean, the easy answer is just China, China, China. And I think that's what the big focus is. But the focus we've got at the moment is what's happening with China macro and how do you position yourself within that? Because clearly there is an opportunity set within China. Clearly there's been a massive derating of stocks there. Clearly there is going to be demand drivers within China going forward, even if you're going to have demographic headwinds, even if you're going to have some structural headwinds with regards to debt restructuring, things like that. There is still extraordinary growth aspects within that market. So it's about trying to pick that out. The geopolitics, which is just fascinating, and I hope we'll have some time to discuss that, because we're looking at individual businesses, and while you look at those individual businesses maybe 5 years ago with just a global lens, now you've got to look at it with a kind of polarization lens in terms of what's going to happen in the US, what's going to happen in China, and which sectors could be at risk there. And I'd say the third area we're focusing on at the moment, and there's a lot of focus from an Asian perspective, is just what's happening in India. India has been on this extraordinary bull run for the last couple of years. A lot of that is because of capital flows coming out of China going into India. And where are we with that? And what opportunity set can we find within India?
It's something I think you touched on in the geopolitical landscape. I mean, and often that's almost a kind of if you like, a bucket term. So, I mean, maybe if we can get into a bit so that we can actually understand it a bit better. Again,
Sure.
so it was exactly, because all we do is we read kind of headlines. I mean, that's it. You read a headline, you read on Twitter, 140 characters. It actually gives you no substance whatsoever. Now, on your point, you just hear China, 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 and geopolitical. So what does it actually mean?
So what it means from us, when we're looking at individual businesses, what we've got to look at is what are the risks. We're looking at businesses which we want to have stable, growing earnings over time, with as much taken out of the formula as possible, out of the equation as possible. So we don't want to be owning a stock which suddenly, because oil's gone to 100, that affects it, or oil's gone to 50, or it's affected by the interest rate cycle, or other kind of resource inputs or things like that. Now, what geopolitics has brought in on that side, therefore, is when you're looking at China tech in particular, and you're looking at what's happened within the semiconductor space, as an example, and what's happened on the regulatory side, there's a whole new aspect and array of different regulation which has come in, which now means that we now need to overlay that on some of the sectors we're looking at. Now, what that does mean is there are a large number of sectors which we just don't look at now, because if you're in particular areas within China tech, you could wake up tomorrow morning and the US could have banned X, Y, and Z, and therefore suddenly, or blacklisted stocks. So if you go back to Huawei as an example, Huawei was, it's the largest mobile phone provider in China, very good business, had got into 5G connectivity and was producing that globally around the world, and 4G as well. The Americans didn't like the look of this because that could be a way of spying on individuals or on corporations or governments, and just ban them. And suddenly Huawei's mobile phones sales went from the 80, 100 million mark down to 10, and the business was blown up. So we've got to be looking at individual stocks in that sense and saying, right, well, two things here. One, are we aligned to US political considerations, or making sure that we're not on the wrong side of that? And secondly, looking on the China side, looking at businesses which we feel are outside the geopolitical considerations, so we can make sure that they're not going to be affected. And I call it the sleep easy thing, Steve, which is we want stocks in the portfolio which we can sleep easy on. So we don't want to wake up with the concern of what if that has happened and it's significantly diminished the value of an individual business.
So what's about? So here you're at. Is obviously you got this US-China tech war as such, and again. And I actually listened to a podcast of yours that you did, I think, at the end of last year. And again, you talk like they're literally, am I right saying the US have put legislation in place which has had a major impact on kind of and on some of the Chinese stocks essentially. And again, it's tech stocks. And is it a kind of a guise in the sense that they're doing it because it's a security fear, or is it more because they're protecting their businesses?
Yeah, great question, Steve, because they dress it up as security, and that they're worried about it being used in military applications. So if we just look at what actually occurred is in October last year, the US came out and said, right, above or below a certain tech threshold, you can't import certain chips into China. So NVIDIA chips were targeted as one example. But you also can't import certain types of technology into China, which would enable the Chinese to produce those types of chips. And the guise around that was that it was because they were worried that it could be used for military applications. Now, there's a couple of things there. The research we've done, and I've looked into this in quite a lot of detail, is that no military applications really use leading edge chips, because when you're dealing with a missile which weighs a ton or whatever it is, whether you're using a 28 nanometer chip or a 5 nanometer chip doesn't actually make much of a difference. So there is a level of that. Now, where they are trying to focus, and I think this is, they're looking 5-10 years ahead, is around AI and how that can be weaponized going forward. Now, when you're looking at artificial intelligence, yes, the speed of your chips and the computational power of your chips is extremely important. Having said that, now that the Chinese can't import certain chips into China, what that means is that actually, instead of using the leading edge chips, let's say, which is a 5 nanometer chip or a 3 nanometer chip, they just use 10 nanometer chips, which are half or a quarter as efficient, but they use 4 times as many. So it doesn't actually stop the capability, it just slows it down. So I feel there is some relative, you could say that there is some aspect of that which actually does have some authority, but really I think it's them trying to protect what's happening to US tech, and it's been very, very effective. Now, one of the things you might have seen recently is the headline around the new Huawei phone, where they produced this new phone which includes a 7 nanometer chip. Now, that 7 nanometer chip is below the threshold of where they thought they'd stop the Chinese. So the Chinese are actually making some advances, which I think could see another round of regulation coming through.
And could be a situation where, and again, I don't want to hop on too long about this, but where actually now, because some are saying these chips are now produced in the US or in Europe, okay, and now The Europeans are also a bit, they don't want to sell to China because they don't want to get on the wrong side of the US
Yeah.
of the US. So now what happens is not the Chinese go, well, actually, then we need to produce it. So now they start building the technology, which then actually has a different impact because they want to become more
Yeah.
powerful because they've got the technology in their own hands.
Yes, exactly. So I
Yeah.
mean, you've opened up. There are so many avenues we go
Yeah.
down. So first of all, let's just have a quick chat on Taiwan there, and I'll ask you a question here, Steve. NVIDIA, which is the leading GPU, so graphic processing unit provider in the world, absolutely, you've seen that share price go absolutely ballistic over the last year or so. Guess what percentage of NVIDIA's chips are manufactured by TSMC, so Taiwan Semiconductor in Taiwan?
I know. It's a real wild guess.
Okay, so it's 100%.
Okay. Well, gee.
100%.
Okay.
And so everyone's
Wow.
like, we're trying to onshore it, but it's a long process to do it. Similarly, guess what percentage of the iPhone leading edge chips are manufactured by TSMC? 100%.
100%.
Yeah,
Yeah.
exactly. So there's an attempt at the moment to try and onshore chip production in the US and in Europe, but they are literally decades away from being
Okay.
where TSMC is. And the analogy I'd use there, and it's the same with the Chinese, is like, well, hold on, Steve, why don't we just like throw hundreds of billions of dollars at this and become self-sufficient? The
Yeah.
analogy to use is anyone who, I'm not a musician, but this is the one we use, is that we have kind of grade 1 to grade 8 in the UK, with grade 8 being the best pianist, grade 1. You can't
Yeah.
go from grade 1 to grade 8 without doing grade 2, 3, 4, 5, 6, 7. And that's the analogy to use for chip production. You can't just jump the queue and go to 7 nanometer. You have to have gone through 28, 20, 16, 14,
Yeah.
all the way through.
Okay.
And so on that point, for instance, TSMC has just signed a contract with Germany, with the EU, where they're going to build a large foundry in Dresden, in Germany. It's a 10 billion euro project. It's a 28 nanometer chip project. Now that is now 8-year legacy kind of technology. So that's where the Europeans are having to start. So it just gives you an idea of how long this process is going to take, but also how intertwined everything is. Now, on the Chinese side, I think the Chinese are, I wouldn't say decades, but they're a long way away from being able to be self-sufficient on leading edge chips. And one of the stock examples there is a company called ASML. So ASML is a Dutch company which makes these lithography units, which is vital for the production of chips. They've been banned from putting their units into China. So the Chinese basically need to say, right, we're starting again, and we're going to produce our own lithography units, DUV and in EUV units. But that is like an 8 to 12-year project. People thought it would be a 20-year project, but I think they'll be able to speed it quicker. But it gives you an idea of the longevity that we're looking at and how hard it is. But also from our perspective, from an investment perspective, how unique these individual assets are. Like trying to replicate them is very, very difficult, and that's where the value in these businesses are.
Yeah, and then just going to kind of your sleep easies. I mean, so again, so your thing is like, what you don't want, as you say, to wake up in the morning and Biden's made a statement, or the US have passing legislation that then you've got to scramble because what you're holding is impacted.
Yes.
And so hence you kind of, as you say, you just take that sector or those stocks just out the equation in terms of your universe.
Yeah.
Okay. No, cool. Happy. India, I mean, so she's not saying you and I spoke about when we had our catch up, but can you maybe just give us a little? I always found the India as a whole fascinating.
Yes.
I love cricket. This might be. I've actually went to watch a cricket game there once. AB de Villiers' 100th Test match in Bangalore. I watched one day cricket and it rained for 4 days, but it was a great trip nonetheless. Maybe give us a sense in terms of what actually is happening in India, and maybe in India, what can maybe some of the businesses that you like.
Sure. I mean, India is fascinating. India has been a real benefactor of capital flowing out of China into India because of concerns around longer-term growth there. What Modi has achieved in India over the last decade is quite phenomenal. India is an incredible place. It's obviously got this extraordinary demographic, which is why people are willing to back such long duration assets there. The valuations on individual companies in India are extraordinarily expensive. But what he's put in place, what Modi's put in place over the last decade is a very significant infrastructure spend. So there's always a problem in India with regards to infrastructure. Getting from one state to another was difficult. It's where you could argue democracy doesn't work so well. So in India, like for instance, Calcutta is ruled by the Communist Party. Delhi's got Congress involved. Mumbai is the BJP. So you've got all these different things. But when a highway is put through from one province to another, when it gets to the provincial line, it just stops because someone on the other side doesn't want it to go. Now, the equivalent in China is they just say, well, we're just going to move that village of 5 million people and we're going to put the highway straight through it. So there was a long period of time where the infrastructure spend in India was very stagnated. Anyway, they've managed to clear that. The second area was the corruption was very high in India. And the problem there is you had all these subsidies which were supposed to be going through to individual villages. And by the time it had gone through the regional government, to the sub-regional government, to the local town, to the local village, the person at the end just didn't get much. And so they brought in this Aadhaar system. And Aadhaar basically is a biometric recognition system whereby you could therefore use your phone to directly receive funds from the government, and it bypassed everybody else. And so suddenly locals got enriched. This is fintech at its very best and emerging markets. And this enriched the rural working class. And that's why you see one of these booms coming through. Now, when we look at individual stocks in India, the capital markets in India is still quite narrow. And that's the problem, that when we're looking for individual businesses, liquidity there is still quite narrow. There aren't that many large businesses for us to invest in. So we very much look at a kind of secondary order. So we will look at something like a Hindustan Unilever, which is Unilever's subsidiary in India. Fantastic business. Got a very long runway for growth. It's a stock actually I own in Asia Franchise as an example. But it trades on 70 times earnings, 70 there. I didn't say 17. So it's extraordinarily expensive. Now, what's another way of owning that? Well, you go and buy the parent company Unilever in the UK, and actually Hindustan Unilever makes up 50%, 40% of Unilever's market cap. So there are different ways of playing it. So as I say, it's a market we're very focused on. At the moment, on an individual stock level, it's difficult for us to find things which exactly match our investment style.
It's actually, it's an interesting story because, again, it just shows how, it demonstrates how the team works. Because, again, so although you're not buying a stock in where you look, what the area you look after, your insights and analysis are then actually, I don't know, but I presume you do own Unilever UK.
So we don't know. We do in some of the funds, not in global franchise though.
Not in global franchise. Okay, but yes, but that's okay. Cool. Now talking about, we've spoken about China, we've spoken about India. We recently had the BRICS summit in SA.
Yes.
With a lot of fanfare. Us guys in Joburg where it was held, we had fighter jets flying over Joburg for a couple of days, keeping I originally thought it was kind of like an air show. And it was actually keeping the airspace clear, which was quite first time I've seen that. A couple of things came out of BRICS. One big statement was around the currency to kind of go against the dollar. Yeah. What are your thoughts about BRICS as a whole? I mean, is it a real threat to the West, kind of, if you like? Yeah. And number two, that kind of is the currency is that going to be a reality?
Yeah. I think threat is probably the wrong word. I think that the global South would like to not be told what to do by Europe and the US. It's like they're just the narrative which continues to come out of the US in particular. I think is something that you look at the way Modi behaves, or you look at the way President Xi behaves, or look within South Africa, or look within Latin America and Brazil, they don't really want to be told what to do. So I think having some level of independence around that. I do think that you will see BRICS being extended, and it was very interesting looking at who was pushing the agenda there. That was very much the Chinese want to extend BRICS. The idea of bringing in the likes of Ethiopia into BRICS, like you could see the South Africans and the Brazilians and Indians actually were quite resolute against that initially, and the Chinese have pushed that through. What I think will be interesting is I do think you'll see the BRICS bloc expand. I think the Ukraine-Russia war is something which is going to lead to a greater level of de-dollarization. And what I mean by that is, at the moment, if you look at where oil and gas or energy from Russia is going and what currency it's being traded in, I mean, India now imports more energy from Russia than it ever has historically. It's something which has been kind of slightly ignored by Europe and the US in terms of what's going on there. But what's interesting for India now, and what's interesting for a lot of the BRIC countries, obviously, around the world, is that they're now able to settle those energy deals in their local currency. So because obviously the US dollar, Russia's been taken off the US dollar system. And so what happens now is India can go, right, we want to do this in rupiah, and we want to have a 5-year contract with you. So they therefore no longer have balance sheet risk with regards to US dollar. So this comes back to actually our very first conversation we had, which was around the Asian financial crisis. Now, one of the reasons for the Asian financial crisis was US dollar debt. So a lot of these countries had borrowed in US dollars at very low rates. The Thai baht then depreciates, they can't afford their debt levels, and they're done. So as a result, the balance sheets of most emerging markets now are very, very conservative. They hold huge levels of foreign currency cash out of concern about what could happen to their balance sheets. Now, if you start transacting in local currencies, so if I'm India and I start doing transacting in rupiah, I don't need to keep $500 billion on my government balance sheet out of concern about what could happen to my currency, because my currency, I'm just transacting in the same currency, so that risk has disappeared. So I do think you are going to get a move towards de-dollarization where possible. I think we're some way off, the renminbi becoming a de facto second currency, but the will is there, is my point. These countries want to move away from dealing in US dollar because it adds balance sheet risk to their own country.
So it's interesting. So it's not just political. It's actually kind of it's financial and looking after my own. Yeah.
And this is where, if you look at GEM ex China over the last 12 months, it's been on an extraordinary bull run. Because of, and this is for one of the reasons, is that they've got very conservative monetary policies. So in general, this is a big generalization. But there's been a freeing up of capital by the fact that they are able to deal a lot of their energy transactions in local currencies. Therefore, they don't need to have the same US dollar reserves as they did previously. And therefore, that's something which can be used to boost the economies going forward.
Okay. Gotcha. It just, again, it just shows kind of what one reads in the press and the slant versus reality, and maybe one's perceptions as well. Cool. Just going back to kind of just before we go there, just reminder to the audience to ask questions. Got a couple have come through, but please, we will get to questions shortly. But otherwise, just don't forget to post them on the Q&A, and then Arifa will help you there. Going to just to kind of back to some kind of stock specific conversation. So away from kind of the political or geopolitical and the nature of those things. So we, again, at this conference we're at recently on Wednesday, is actually the INN8 Investment Summit, which was fascinating. We actually had your CEO on a CEO panel, and that was very entertaining. But at the conference, there's a lot of talk about the Magnificent Seven.
Yes.
Okay. So first and foremost, maybe let's talk about what or who are the Magnificent Seven. And then I know that you only hold two of the stocks, and maybe we can get into that a bit as well.
Yeah. So I mean, it's one of these interesting things where we found it very frustrating from a global fund perspective, but also fascinating that you've had these 7 businesses, your Amazons, Nvidias, Google, Microsoft, Apple, etc., who really been the market leaders and led to this extraordinary run in the S&P, and actually makes active management around that quite difficult and quite challenging. It's like, well, why don't you just put money into the trackers? So what's fascinating from us is that we look at those businesses. All of those businesses are fantastic businesses. However, only some of them fit our philosophy. So we currently own Google and Microsoft. And the reason we own those businesses is they have what we're looking for. When you're looking at the top 30 stocks in the world, which is what we look to invest in, we're looking at this very concentrated portfolio. We're looking at stocks which we think are going to compound over a long period of time, where we've got great see-through on what's going to happen to those businesses on a long duration basis. When we look at the likes of Tesla or Amazon.
So just quickly on that, sorry.
Yes.
So the seven are
Yes.
it's Microsoft,
Yes.
Google / Alphabet,
yes,
Apple,
yes,
Tesla.
yes.
You mentioned what's it, NVIDIA?
NVIDIA, yeah.
NVIDIA, thank you, sorry.
Yeah.
And then and I'm missing one or two there.
Which is the last one?
It's an obvious one. It's obvious.
Anyway, I'll come back.
Microsoft? No, we said Microsoft.
Microsoft.
Yeah. Okay.
Anyway,
it's basically Facebook. Yeah. So it's your seven big tech businesses. That essentially, I mean, no, Tesla you could argue is a tech or not, but
tech business.
Yeah. Okay.
So seven large tech businesses, and we look at those, and we look at, let's say, your Teslas of this world, or Amazon. And so why don't we own those as businesses? Because they are brilliant businesses, don't get me wrong. What they've achieved there is phenomenal. Is that we don't know what is Tesla's margin going to end up as? What is the see-through economics on Tesla? So it's still at this building phase. It's still got incredible capital requirements to expand and go forward. You don't really know what Tesla is going to have as see-through economics in terms of what its margins are going to be. The same with Amazon. Amazon runs its e-commerce business at a zero margin basis, basically. So it is trying to encapsulate the whole of the e-commerce environment. And the way it's doing that is it says, right, well, we'll take products and we'll basically sell them at the same cost. And the way they effectively make money is through the working capital cycle. And what I mean by that is you as a buyer, Steve, you would go onto Amazon, you buy your product, you buy your TV, whatever it might be, you pay immediately. Amazon don't really have that much inventory, but they'll only pay the manufacturer in 2 or 3 months' time. So as long as you're growing, you're actually generating very good cash flow, even off zero margin. Now it's a clever business model, don't get me wrong, but it's not the type of business that we're interested in, because you don't really know what's happening on a see-through economics basis. Now, then when we look at the likes of NVIDIA, now NVIDIA is obviously part of the semiconductor spectrum that we talked about. NVIDIA, again, is a brilliant business, but it is very much in the hot seat at the moment around artificial intelligence and what's happening to data server demand. Now, the longevity of that, again, is uncertain. But what we will do is we will use what's happening with NVIDIA to look at the other businesses that we might want to own in that sector. So we'd prefer to own, as I mentioned before, ASML, which is part of the semiconductor spectrum, but we think has more value in that chain than the likes of NVIDIA. It's interesting that we just produced a report on Apple, so that's going to be debated by the team in a couple of weeks' time. It doesn't necessarily mean it's going to go in, but Apple is a very good business for us to be looking at, because it has so many implications for our other holdings, and what's happening. Let's say, as an example, there we own some of the global gaming companies, and they obviously have a take rate which they pay to Apple when you go onto iOS and onto iTunes, etc.
Yeah.
So we need to find out what's going to happen to that take rate going forward. So we're constantly debating these positions, but getting into that top 30 stocks, it's a difficult proposition, and not all those Magnificent Seven hit those criteria.
Okay. Yeah, which makes it. That's why, and they make up about 24-25% of the MSCI index. Yeah, so they're chunky, eh? I mean, it's yeah. Got a couple of questions from the audience which I'd like to get to, because if we don't, then we miss them. So the first question is from Sean. What is your view on AI as an investable opportunity, and how are you playing into this?
Sure. Great question.
AI, hot topic, AI.
Very, very hot topic.
Yeah.
So how are we doing that? So we very much have taken the approach, and this is what we do with a lot of our businesses, of taking the approach of, right, AI is a very useful tool. I think it's going to be an extraordinary opportunity for a lot of businesses going forward, but there's a lot of unknowns around it. So we're taking very much the analogy I'd use of the gold rush on the west coast of the US. That the people who made money in the gold rush weren't the gold miners, but the people who sold the picks and shovels. And that's how we're taking our initial approach really with regards to AI. So, AI requires extraordinary computational power going forward, and the demand there for semiconductors is very, very high. So we're looking at the likes of ASML, which has got an order book because of the demand you've got around AI going forward to either 2026, 2027. So it gives us great visibility there. We also own Samsung as an example, because within artificial intelligence, you have two types of chips. You have your logic chip and you have your memory chip. Samsung is the leader in memory chip production globally, and AI is creating very, very high level of demands for memory at this stage. So we're looking at it on that side. The most direct play we have around AI is Microsoft. And I think Microsoft is the one stock which has the capability to really advance on AI and monetize AI. And you're seeing some quite significant evidence of that coming through at the moment. The hot stock around AI, and it's something we debated to a great kind of level of detail within the team, was NVIDIA. But when, again, we look at NVIDIA, what we're concerned about there is that there is a high level of demand for their individual chips right now, but what happens in years 2, years 3, we just don't have that level of visibility. So we continue to discuss that position, but at the moment it's on the sideline.
Yeah, actually talking about semiconductors, you've got a very good podcast, which is the one I listened to, which is 45 minutes about semiconductors. Which again I think is fascinating. So hopefully the team can share that with the audience if they want to know more about semiconductors. Just another question. Just slightly off topic, but I think it's a goodie. When would you expect your strategy to perform? Extremely bad or extremely good? Under which market conditions?
Sorry, I just question.
Sorry. So when would you expect your strategy or the global franchise portfolio to perform? In really, really well or really, really badly, and in which market conditions? So probably actually a nice question for you to answer. Yeah.
No, do you know what? It's a great question. And the way I'd look at global franchise is global franchise basically compounds its free cash flow at a low double in US dollars at a low double-digit rate per annum. On top of that, it receives a couple of % in terms of dividends or share buybacks. So that's the type of free cash flow return that you're getting from global franchise. Now, obviously, what happens around that is valuations go up and down. So valuations in terms of longer duration assets or shorter duration assets. But if you hold global franchise for a long period of time, that's the type of return that you're going to get. Now, then you have individual market conditions. Now, the conditions where global franchise will underperform the market as a whole is if you get a very sharp cyclical rally, because we just don't own those types of businesses here. We don't own your quasi-national banks. We don't own resources. So we would just underperform during that. The periods where it performs is at its best is when markets are either going flat or going down. Yeah, it's just a great protector of capital. And so the way we look at it is that we participate meaningfully in up markets, but outperform in down markets or flat markets. So when we're looking at the current environment where there's a great deal of uncertainty, there's a great deal of price inflation coming through, where you've really got to have pricing power, that's something we focus on in the fund. So when you look at the individual stocks that we own, they've been able to pass through any price increases they're receiving from cost inflation and being able to protect their margins. So having those businesses with that high starting operating margins and gross margins means they're able to protect their earnings going forward. And I think that's why you're seeing relatively strong performance from the fund.
Okay. Yeah. And I suppose also, as you see, so you try and avoid the shocks as much as possible. But also, and you said earlier, you've got a very concentrated portfolio. How long do you typically hold a stock for?
Sure. So, I mean, and again, this is where it's so fascinating. So we've got 27, 28 stocks in the portfolio currently. We probably average 2 or 3 stocks turning over per year. Now, if you just back that out, Steve, that means your holding period is 5 years plus. Yeah, and we've got stocks which we've held in there for longer than that. And I think that's where our USP really comes through is most stocks are discounted on a 1-year basis or on a 2-year basis. But we're doing the research around these businesses, which means that we have confidence in what's going to happen in year 3 onwards. And that's not normally priced in. What's normally priced in on year 3 onwards is that if you're receiving very high returns on invested capital, the assumption is competition is going to come in and erode that. So if you can find those businesses that for whatever reason have a unique selling point and a unique attribute which maintains that high return, that's why you continue to receive those better returns. But it does mean you tend to be buying stocks which are a slightly higher valuation at the front end, but we're looking at what's going to happen in that kind of year 3 plus basis.
So one thing again, it's like I'm diverging. Sorry, we'll get back to the questions now.
Yeah.
Is in talking to Morkel. Morkel sent you through a pack about the global franchise, and in there's a slide which almost has got the day in the life of an individual. Okay, yeah. And I'm going to describe it badly here, and it basically, but it starts with kind of, you wake up, you get in the shower, you have breakfast, you get in your car, you go to work, you log in, etc., etc., etc. But in there, it overlays like almost some of the businesses that individuals touch day in and day out. So maybe you can also just talk us through the story of that concept.
Yeah. So conceptually, what you want is, when we're looking at individual businesses, you want businesses which are people want to use on a daily basis. You want to have businesses which you use because everybody else is using. So if we look at like a Microsoft as an example, does Microsoft have the best formatting capabilities of any product in the world? No. But we use Word and Excel because if I've got a Word document and I need to send it to you, Steve, if you're not using Word, we can't do it. So what that means is you have this extraordinary network effect. And therefore, for someone to come in and usurp that, they need to produce a product, first of all, which is materially better than what Microsoft is producing currently, but then also have the capability to send it out to 2 billion people in the world simultaneously. So that's just not going to happen.
I always think like a PowerPoint is actually a great example. There's PowerPoint in corporates. We all use PowerPoint, but it's not the best product.
It's not,
and everyone moans about it, but we still use it.
Precisely. Yeah. And it's the same with, let's say, the card networks. Your Visas or Mastercards. That are those operating rails the best? No, but everyone's using it. So therefore, you've got to maintain that system going forward. Other examples of that network effect would be something like a Bookings. So Bookings is one of the largest online travel agents. Why does that work so well? Well, it works because all the flights and all the hotels are on there, and all the customers are on there as well. And therefore, by default, if you're not on that platform, you're not going to get the best of both worlds. So we look a lot for those individual kind of network effects, which kind of basically become self-fulfilling, that as they get bigger, more people have to use them, and et cetera, et cetera. So then outside of that, you're really looking at kind of businesses which have unique kind of IP. And so, we look at something like Electronic Arts. So Electronic Arts, EA, that owns the FIFA franchise. Well, it's not anymore, but it's still got that thing. That has got an incredible number of followers, which every time the new edition of that gets released, you'll see that more and more people subscribe to it. They're able to increase the subscription price, incredibly cash generative. But again, it comes back to that network effect. We used to own a lot of consumer staples, and that's something which, when you look at that chart in terms of what people use on a daily basis. But one of the things we're focusing on increasingly, and we've done a great deal of study on this, is around disruption. Because what you're seeing happening at the moment is there is greater disruption at a business level than there's ever been previously. You look at individual businesses which might have had a USP around their distribution of various products. Well, e-commerce has completely nailed that. So when we look at consumer staples as an example, consumer staples 10, 12 years ago used to be about 60% of global franchise in terms of our allocation. And now it's down to about 15%. And what do we now own? Because we think they've got actual pricing power going forward, is the likes of Nestle. So you look at Nestle. Nestle's 2 biggest core products is coffee, obviously, but also it's also pet food. So never bet against pets is one of the things that we say, because people are willing to spend more money on that than anything else. But you've got to go and find these niche products where you have pricing power within those particular areas, and therefore are able to maintain their margins on a longer term basis. So so we're looking for these stocks which have continual usage on a daily basis in everybody's lives, but also stocks which are very hard to move away from once you're in the system.
Yeah. So I always think pets and children, eh? Should have gone
Yes,
to the baby business a long time ago.
exactly.
Yeah, yeah, yeah. Just quickly go back to a couple of questions. I did skip. So another one from Rustum. With BRICS coming about, do you think short term we could follow the currency route that the euro went through?
In terms of what, becoming a single currency?
Yeah, I think it sounds like that
Yeah.
that BRICS currency idea. Yeah, yeah.
No, I think we're some way off from that. Because, as I said, but what the examples we're getting at the moment is that people, individual countries want to transact in their local currency, and that's stage one. And so that's what we're seeing increasingly happen is, if you're dealing with China, you are increasingly transacting in renminbi. If you've got any sort of energy demands coming out of Russia and you're paying for that, you're paying your local currencies. For there to be an individual currency, which, let's face it, would have to be renminbi based, because
Yeah.
that would be the base of the currency. That can't really happen until we get an open capital account in China. So at the moment, Chinese capital can't flow in and out freely out of the country. So therefore, if we were to start transacting in renminbi, it's very difficult for us to transact in that. So I think we're quite a number of years away from that. But I think we are definitely in stage one, or level one of that process occurring, as people become more comfortable in transacting in non-US dollar denominations.
Cool. And then one more question, also from Sean. Considering growing multi-popularity popularity across the world and disparity between rich and poor, what is your view on investing into infrastructure, water scarcity,
Sure.
etc.?
Yeah. So growing multi-polarity.
Polarity, sorry. Thanks.
That's it. It's not something we do, but I can see the attractiveness of it. Now, the reason we don't do that is because you're deeply beholden to local regulation. So you could come in and go, right, within South Africa, I lived in Cape Town for 3 years and had a fantastic time but we were right in the middle of the water crisis at that period. Now, if you come in, let's say, and put some infrastructure in place and spend a lot of money on creating the right local water dynamics, you could do well for a number of years, but then the government could actually change its policy and suddenly your assets are taken out. So that's one of the reasons we don't invest in those types of sectors. I think there is going to be a great deal of geopolitical concern around water scarcity. You look at what's happening to the Nile at the moment. Ethiopia has just put in a new dam on the Blue Nile, which could significantly reduce river flow there in the Nile into Egypt. Egypt's got very concerned about that. So it's something we need to take into consideration when we're looking at individual businesses, but it's not an area we would go and invest in, because I just think there's too much regulatory risk around it.
And then maybe just a side question. I mean, ESG. I mean, or sustainability. It's always a very responsible investing, and I know you guys take that very seriously.
Yes.
And again, on the conversation that was had at the investment summit on Wednesday, is that a lot of the time for companies, a real tick the box exercise.
Yes.
And another view I've heard around kind of ESG is actually has negative impact can have a negative impact on the portfolio. So what's your view on ESG and yeah.
Sure. I mean, and actually, Sean, you asked Steve. I mean, you actually asked the question earlier, which I think was very effective around how we view it. Is that our holding period for individual stocks is 5 years plus. Now, by default, therefore, if those individual businesses aren't sustainable in every aspect, then we're going to get blown up, or our investors are going to get blown up. So when we look at individual businesses, sustainability is actually inbuilt into our process. I think a lot of funds at the moment are going through this kind of greenwashing period of like trying to show their ESG credentials and the rest of it.
Yeah.
You look at Global Franchise on a headline basis, it has phenomenal sustainability credentials because of the type of businesses we're invested in, and because of the long-term nature of our investments. So if you're investing in something for a 5-year basis, if your business model, within your business model, if you're not treating your suppliers correctly, if you are mispricing to your customers, you're going to get found out. If you're on the financial model side, if you are not looking after your balance sheet, if you're not being a corporate responsible company in terms of what you're doing to shareholder returns or correctly investing, you're going to get found out as well. So that's the other side. And then on the when you're looking at the on the kind of the capital allocation side and looking at the corporate governance, if you don't have the correct board of directors in, if you don't have the correct CEO in, if you're not looking at the correct levels of diversity, again, you're going to get found out. So it's very much inbuilt. Now, that doesn't say that all our companies are perfect. And what we are increasingly doing is obviously engaging around individual aspects. So, we talked about EA earlier, Electronic Arts, around FIFA. Yeah. One of the things they used to do is a thing called a loot box. So loot box, it was debatable whether loot box is when you pay for a number of cards to then see which players you then get on FIFA. And obviously everyone's after trying to get kind of Messi or Ronaldo or whatever, Mbappe maybe rather than Messi or Ronaldo now. And what it was debatable was, is that actually gambling for individuals where you're paying for something you don't know what you're getting back? And so we engaged around that. And we've had some very successful engagements around our company kind of correspondence like that. So we're not saying we're perfect, and we're certainly looking at engaging as much as possible on areas that are concerned to us.
And I suppose what you're saying is that, so because of your process, actually ESG takes care of itself.
To a degree, but I don't want to sound
yes,
like we're relaxing, because if you're not happy to say that we're fine because we're taking a long step, that's not the case.
Yes.
There's no company which is absolute hundreds. So we need to make sure that we're pushing as well on the other side.
Okay. No. Cool. Happy. Just also, we've only got 8 minutes left, so time does go quite quickly with these things. So saying again, bringing it back to kind of the Asian conversation.
Yes.
Which businesses in Asia are kind of knocking on the door for the global franchise at the moment?
Yeah, it's a great question. So at the moment, with regards to direct ownership of Asian businesses, we own NetEase, which is a Chinese gaming company, which has been, China equities generally have performed pretty poorly. NetEase has performed phenomenally well over the last number of years because of the consistency of its returns. And we also own Samsung. So obviously that's part of the semiconductor spectrum which we were talking about previously. So when we're looking at individual businesses, one of the first things we look at is obviously single country risk. And so as a general rule, when you look at the types of stocks that we own, we don't look for stocks which have just got Indian exposure or just got Chinese exposure, because that creates single country risk. So a lot of the businesses we own from an Asia exposure perspective in global franchise is more to do with their geographic revenue exposure. So we might own like an Estee Lauder as an example, where it's obviously a global cosmetics company, but it's got a very high level of revenue being generated from China. There are a number of stocks we've looked at recently. There's a company called Kweichow Moutai, which you might not have heard of.
No. It's
actually the largest alcohol company in the world, the largest beverage company in the world by market cap, $300 billion. It's a Chinese listed company, and it produces a drink called Baijiu, which is like the national drink. It's a phenomenal business which compounds away at 10 to 15% a year. It's absolute premium luxury product which everyone in China is trying to buy. There's limited supply, very strong demand. So that's the type of business that we have been presenting to global franchise and looking at trying to knock on the door. As an example, they've got, Kweichow Moutai is one of the largest positions in Asia franchise. So the way we work as a team is you have global franchise, you have these other funds which we have. So we have an American franchise, we have Asia franchise. We're all trying to jockey to get our individual stocks, or the stocks that we particularly like, into global franchise, and that creates great kind of competition for capital. So we're constantly looking on that side. But as I say, one of the starting points there, as we talked about with Hindustan Unilever earlier, is just making sure we don't have too much single country risk. And if you can get that geographic diversity, then that's obviously a benefit.
Okay, cool. So only got five minutes left. So if there are any more questions, anything else has come through, we're happy, but you send them. So just also, again, slightly off topic, you spoke about greenwashing, and something I've also been curious about is sports washing. So,
Yes.
and the whole thing about kind of Saudi putting a lot of money into a whole bunch of different sports.
Yes.
I mean, it seems to have a real positive impact on one's perception of the country. So it seems like it works.
Yes. Yeah. I mean, hats off to them. I mean, Saudi Arabia, what Saudi Arabia has achieved is quite, I think, quite phenomenal.
Yeah,
I I slightly, when I look at individual countries, I very much put my emerging market hat on. And what
yeah,
I mean by that is I want to see progression. I don't look at where they are now. So
yeah,
Saudi Arabia has many, many things which are wrong with it. But if you look at the Saudi Arabia of today compared to Saudi Arabia of 5 years ago or 10 years ago, it's made extraordinary changes. You know, fine, women's rights in Saudi Arabia are still appalling, but they're way
yeah,
better than they were 5 years ago. And what I'd like to think is that progression is going to continue over the next 5 or 10 years. So I'm a supporter of what they're trying to achieve in the Middle East. I think it's positive that you are therefore going to get improvements in human rights, in individuals' rights, economic development, etc. So I'm a supporter of that. I think the Chinese could learn a few things from what the Middle East is achieving in terms of
yeah.
making sure that outside perception is actually quite important in terms of how people view individual countries. So let's see where it finishes. Obviously this is quite reliant on oil revenue continuing for quite a considerable period of time. But I think what they're doing is debatable in terms of the impact on the individual industries. But if it is creating social kind of responsibility, if it's creating social advancement, then it's got to be something that we should be positive around.
Yeah, and I suppose, well, yeah, as you said, a lot of the time I think the lens we're looking at is almost today and the stories of the past, maybe quite recent past sometimes. But if you,
Yeah,
as you're saying, if you're looking forward and where they've come from, yeah,
yeah,
I think it's fair. I do. I also like, you look at the World Cup in Qatar last year. A lot of
yeah,
noise beforehand, and I know it's not sad, but a lot of noise beforehand.
yeah,
But shucks, we all love the tournament, so that's
yeah,
a fact. Yeah, we supported it. Yeah, yeah. Cool. So we actually come to the end. So Charlie, so first of all, thank you very, very much for your time. Really do appreciate it. Thanks to the audience for joining. Yeah, we again really do appreciate your time. I think a Friday morning works well. Please feed back to us if you feel that the Friday morning is the right time. We used to have them on Tuesdays. We recently moved into Fridays, but so far I think it's gone quite well. Just to close off, just a reminder on CPD points. If you stay the whole webinar, then you do get your one CPD point. It's good. It's an hour, Charlie. We can't get more for an hour.
okay,
And if you weren't able to join in the beginning, you can do it. You'll do a short assessment. We will send out a thank you note to all, and then there's the recording and the assessment and your CPD point will come as well. Lastly, if you want to know more about INN8, please follow us on LinkedIn. We've got a lot of stuff on LinkedIn, and all our kind of future webinars and that are posted on LinkedIn. It's a great way to keep up with kind of what we're up to. Otherwise, that's it. Yeah, thanks, Charlie, and have a great weekend. Hopefully the English beat Japan on I think it's on Sunday evening.
yeah.
Hopefully, I'm sure the Boks will beat Romania. Yeah.
Of
Okay,
course.
cool. Thanks, Charlie.
INN8 is a registered trademark of Stanlib Wealth Management Pty Limited, an authorised financial services provider.